It's been a little while since we talked about Deutsche Bank. That thing, I mean, it's this bank is finished. I've already heard that the government may step in and merge Deutsche Bank with this other bank, because basically it's a rotting carcass that is going to implode on its own. Matter of fact, I believe Deutsche Bank was named in one of the White Dove reports. I don't know if it was the first and second, or just the first, or just the second. But boy, is this thing in trouble. Wolfstreet.com. Deutsche Bank death spiral hits historic low. European banks follow. Bottom fishers were taken out back and shot. It just doesn't let up with Deutsche Bank or with European banks in general. A new day, a new scandal, a new historic low in the share price that has been in a death spiral for over 10 years. Deutsche Bank shares plunged 7% today, as in December 20th, actually, in Frankfurt to a new historic low of €7 per share, after briefly threatening to close at an ignominious 6.99 euros. Its market cap is now down to just 14 billion euros. The stock has plunged 56% this year. The European Commission, the executive branch of the EU, after nearly 3 years of investigating this, announced today that it suspects 4 unnamed banks of colluding to manipulate the vast market for US dollar-denominated government-backed bonds between 2009 and 2015. Again, another day, another scandal. It's the same big banks. Pay a little fine. Everything's going to be fine. It's going to be okay. If you and I did anything like this in our own lives, we'd be thrown in jail. There'd be no such thing as pay a fine and, blah, blah, blah. There's no such thing. The European Commission has informed 4 banks of its preliminary view that they have breached EU antitrust rules by colluding in periods from 2009 to 2015 to distort competition in secondary market trading in the EEA of supra-sovereign, sovereign, and agency bonds denominated in US dollars, the statement said. The Commission has concerns that the 4 banks exchanged commercially sensitive information and coordinated on prices, it said. These contacts would have taken place mainly through online chat rooms. Deutsche Bank and Credit Suisse confirmed that they are among the 4. This is just the latest in an endless series of allegations of wrongdoing and costly settlements of such cases. This is in addition to the bank's bulging portfolio, so to speak, of operational and financial problems. Deutsche Bank's contingent convertible bonds designed to be bailed in, not bailed out, bailed in, when the bank's regulatory capital falls below a certain level, are a measure of what the market thinks about the chance of such an event. They're unsecured, perpetual bonds that can be canceled when regulators think the bank needs more capital to avoid toppling. In this event, stockholders and cocoa bondholders will likely get wiped out by taking the first loss. Again, you get bailed in. Sorry about your luck. Other creditors might get a haircut, and taxpayers would be shanghaied into paying for further capital if need be. So not only do you have a bail-in, you might even get a bailout if need be. Bad enough. With these risks, COCOs have a fairly high coupon payment to begin with. To make them attractive, and now the 6% COCOs are added again, giving their opinion about the chances of a bail-in, they have been plunging, closing today at 83.6 cents on the euro. Deutsche Bank stock has been in a death spiral since 2007, following an intense price bubble that ensued as the once conservatively run Bank for Germany, Inc., and German retail customers transitioned to becoming a global player in just about everything that has caused banks to collapse. Bottom fishers were regularly taken out and out back and shot. Deutsche Bank was as high as like 120, almost 120 per share, down to 7, 94% loss. What, is this a cryptocurrency? What are we looking at? Are we looking at cryptos? 94, 82% down? No, it's just a walking carcass, dead walking bank. Deutsche Bank's biting the dust. But it's wait, there's more. It's not just Deutsche Bank. The outfit is an example of a broader development in Europe, where the years of following the financial crisis, the years of zero interest rate policy and negative interest rate policy, ZERP and NERP, weren't used to rebuild bank capital and clean up balance sheets and get rid of non-performing loans, but were instead used to prop up the sovereign debt of Euro countries whose governments can't handle a hard currency that they can't devalue, such as Greece, Italy, Spain, and Portugal. Propping up government debts worked. But the banks, the financial infrastructure of an economy, are a massive unfixed risk. Under the new rules, bailouts would now wipe out, or at least crush, shareholders and some junior creditors, such as cocoa bondholders, before taxpayers will be shanghaied into cleaning up the rest. Today, the stocks of European banks, as depicted by the Stoxx 600 Banks Index, dropped 2.5%. The index has plunged 33% from its 52-week high back in January. But going back a decade, this 33% plunge is just a dimple compared to the epic 75% collapse that the European bank peak in 2007 that rivals the NASDAQ collapse of 78% in 2001 to 2003. The NASDAQ has more than recovered, while the European banks are just bumping along from hopeless to hope and back to hopeless. Clearly, the market sees these European banks as a mess that will remain a mess and has a superb chance of getting a lot messier. Take care.